everybody. And on this episode of Making Sense in the Markets with Team LWC, I'm joined by Craig Basinger, Chief Strategist and Lead Portfolio Manager at Purpose Investments. Thanks for joining us today, Craig.
Thanks for having me, Chris.
One of the key thoughts on most investors' minds are we going to enter a technical recession in 2023? What are your thoughts?
Yeah, I mean, it's certainly been one of the more unique economic cycles that we've seen in quite some time. I think we're still even dealing with some of the legacy issues from pandemic-induced changes of behavior in our spending patterns, in our travel patterns, and I think that's sort of complicated things to a certain degree. We've got really strong labor markets, which would have most people thinking, what recession? I mean, the airplanes are full, everybody's getting a job, but the fact is that's all sort of just still recovering from the pandemic. And meanwhile, we're starting to see a material slowdown in a whole bunch of other industries. And I think once you add on all the rate hikes that were implemented last year by central banks, including the US Fed, Bank of Canada, and just about almost all the others, that's all going to weigh onto the economy this year, and because there is a lagged impact. So fighting inflation, I think they've done a great job in getting it under control, but the fact is we fight inflation by slowing down the economy, and that's largely what we're going to see this year. So do we get a full-blown recession? Hard to say, but certainly we're going to see some deceleration of economic activity.
Do we need to see those labor markets roll over for it to be a recession in your mind, or can we kind of have that economic pain with that strength we've seen in that labor backdrop?
I mean, I think nothing would make anybody happier than like a resilient labor market in a recession. I find that hard to sort of fathom how that would work itself out. In fact, if you look beyond the leisure jobs and hospitality that are again still recovering from catching up from the pandemic, we're seeing a material slowdown in a lot of the other industries, manufacturing, industrials, and I think that's going to continue to spread over time as this year progresses. So I think labor will take it on the chin a little bit, but not nearly as bad as some of the past recessions.
We marked the lows for the stock market in June. We almost tested them in October. Do you think we see another test of those equity market lows, or do you feel like the worst is behind us?
Well, I mean, I'll be honest, we expected this year to start off well in the equity markets, and it did. None of us, I think, expected this good of a start. So of course, every bear market ends on hope and the market rallies and nobody believes it. Nobody believes it's going to last. Could this be that? Maybe, but in our, the way we're looking at it, the equity market's bouncing back because inflation's gotten a bit under control. But underneath that, I think we're starting to see earnings revisions continue to roll over and the economy starting to soften. So we just have a hard time believing that this is going to be a sustainable rally. And we think we could see potentially a lower low, but at the very least, I think we'll see a fair bit of weakness in the coming months in the first half of this year.
And obviously there's that mix between equities and bonds, and I won't steal the thunder about your fund, but we obviously saw bond yields rise from historical lows to 4.5%, depending on the country, and now kind of coming back down. Where do you expect bond yields to go over the near term here?
Yeah, I mean, last year inflation ramped up, short-term interest rates ramped up in response, and bond yields rose as well pretty materially. We've now been sort of in a almost 2-year bear market in bonds, because bonds started dropping at the beginning of 2021. Where do they go from here? I think inflation gets under control, and if the economy does start to slow down, I think that's going to stop any material rise in bonds and possibly even put some downward pressure on yields, which is good for the price because obviously bonds really failed as their stabilizer job last year. But so far this year, I think they're off to a decent start and probably an asset class that's a lot safer than it used to be when bond yields were much lower. So we're a fair bit more constructive on the bond market at this point, meaning bond yields shouldn't go materially higher.
And there finally is a reasonable alternative.
There is yield everywhere now. It was a painful journey to get here, but it's a better place to be.
Well, this is our first episode of the Manager Due Diligence series in Making Sense of the Markets, and thanks for joining us.
Thanks.